All right. Thanks, Ernest, for the introduction and the organizers for the invitation. This is going to be kind of a composite talk touching upon definitely economic and finance issues, network theory, and of course some statistics. So to disambiguate a little bit the title, I'll start by having a fairly lengthy discussion about issues of systemic risk, and then how this translates into networks, and then depends on the type of data that are available, how we estimate those networks, and what are the implications going back, closing the loop to systemic risk. So if you look at, this is the Wikipedia definition, systemic risk is essentially at a high level the possibility of an event that essentially is going to trigger instability into the entire system and may even take it down. And the system can be either an industry or a whole economy, and so on and so forth. And of course, systemic risk has become so important, especially since the financial crisis, and you see it in the popular press, on TV, and so forth, because essentially, in the case of the financial crisis, but involved the financial system, eventually it had huge implications in terms of welfare and eventually economic growth. And even 10 years after the financial crisis, the effects of those events are still with us. However, the next few slides, essentially, I put them together by looking at a lot of the reports that central banks around the world, the Federal Reserve in the US, the Bank of England in the UK, and the European Central Bank covering the Eurozone, put in the reports essentially to parliamentary bodies, trying sort of to work through definitions of systemic risk, drivers of systemic risk. So this is sort of at a very high level summary of the information that came out of these reports. So systemic risk is, in those, from a more formal perspective, is the risk of experiencing a strong systemic event, and essentially such an event adversely affects a number of systemically important intermediaries or markets. So right now we start thinking more about financial systems. And of course, the related infrastructure. Of course, this very general definition can apply to other infrastructures beyond the financial system. Okay, since you have an event, what is the trigger of the event? It can be either an exogenous shock that came outside the system, or it could emerge slowly over time, endogenously through the system. So you immediately start seeing how things become more complicated, because you need to start thinking both about when you start modeling or when you start building either economic or statistical models addressing systemic risk issues, you need to think about whether your shocks are exogenous or they have an endogenous type of characteristic. And these systemic events can either be strong when there are intermediaries involved as part of the system and they start failing, or in that case, they can also lead to nonlinearities or regime changes. So in general, when you look at the literature today, and a lot of the literature emerged over essentially the last 10, 11 years since the financial crisis, there are in general three main forms of systemic risk. One is contagion risk, and I'm going to talk much more about contagion risk because this is sort of the main focus of this talk. Risk of macro shocks that can create simultaneous displacements, and also risk of unraveling imbalances that have been built over time. So you see that the third type of risk has some form of endogeneity, as I previously mentioned. So focusing a little bit more on contagion, essentially it starts with an idiosyncratic problem, let's say a key bank or another key financial institution, since we're talking about the financial system, and eventually starts spreading through the system, whatever the system is, the banking system or the broader financial system. And usually there is kind of a cascading mechanism. And that's where networks are going to start coming into the picture, because you need to start thinking about the transmission mechanism. So as the typical example is you have a bank failure, and then something changes, and what is a transmission channel. There are multiple transmission channels, and I'll mention a few things about that. And then it starts causing the failure of another bank, although initially the second bank seemed solvent. So what may have changed is changes in expectations, which is a very big thing in economics and finance, or maybe suddenly the public or other financial actors start paying more attention to information that may have been out there, but they haven't fully processed it. So something changes there were some changes in the information set. Moving on to large exogenous shocks, I mean, these are easier sort of to understand. Essentially, this is a shock that hits the entire system or a good chunk of the system and essentially affects a large number of intermediaries or entire markets in a simultaneous fashion. And these are sort of, this type of exogenous shocks in terms of systemic risk, these are the most well understood because essentially they are related to economic downturns. And there is a very, very, very extensive literature over the last 70, 100 years on trying to understand how exogenous shocks are propagated through financial systems. And then the unraveling of widespread imbalances, this is an endogenous type of shock because essentially there were these imbalances building over time, and a typical example is sort of the lending boom in the early 2000s in the mortgage market, but eventually suddenly people realized that that has built-in imbalances that need to be unraveled, and suddenly a lot of banks' balance sheets or other financial institutions' balance sheets didn't seem as sturdy as initially anticipated. All right, a little bit more about the drivers, why all these things happen, and again, there's an extensive economic literature, but this essentially connects to very fundamental ideas in economics and finance, like asymmetric information, incomplete markets, externalities, and so on and so forth. And essentially, all these aspects create, the message to keep in mind is that eventually this creates potential strong feedback mechanisms, amplification, and nonlinearities. But essentially it starts giving you some flavor of why, there has been a lot of work on systemic risk, but still there is much more work to be done because it involves a lot of players and a lot of different transmission channels and potential mechanisms. So that's sort of the upshot of this very brief introduction to systemic risk. It's a very complex phenomenon, and at the same time, if you're trying to develop an aggregate framework, to some extent you need to capture all these nuances, and that becomes kind of a really challenging task. So, in this talk, I'm going to just focus on a small sliver of the problem, and especially also keeping in mind that if you were to build such a big aggregate framework and at the same time test it with data, somehow you need to get access to the data, which, as we're going to see, becomes another challenging task. So in this talk, we're going to focus only on contagion risk and the role of interconnectedness, and focus only on banks, because the collaborators were able to purchase data and develop a modeling framework. Okay, so let's discuss a little bit contagion risk and interbank markets. So in the old days, before deposit insurance, so we're talking about, think about banking runs in the 1850s or in the 1910s and so on and so forth, the contagion risk was one bank will have a failure, there will be a run on the bank, and then suddenly for a lot of other banks, the depositors will say our savings are not safe, and then that will be the cascading effect. And essentially that channel has been completely removed with the introduction, or essentially removed with the introduction of deposit insurance. So right now in the 2008, the locus of systemic risk through this channel were the interbank markets where banks lend to each other overnight or for longer durations and so forth. And therefore, if you think So essentially, in this particular case, if you think about the channel of transmission, are these physical exposures amongst banks in those type of markets. And essentially, what happens is a bank may start having liquidity problems because it has a temporary shortfall, it needs to borrow funds to cover some obligations for its clients, and the other banks have information or they start deeming it too risky, and therefore essentially they start translating into a liquidity shock. And this is a really seminal paper in this type of literature, the Allen and Gale 2000, that essentially started building such a transmission mechanism, and it's one of the first papers where the notion of a network and the importance of networks start appearing in the financial literature. Next slide. So another channel emerges sort of through informational processes, and in this particular case, what happens is, it looks at other aspects of the balance sheets of banks, and then they start thinking, okay, this bank holds this type of assets, these assets are not that stable anymore, or they're not deemed as high quality, and therefore some market participants may start feeling that this is the case, whereas some others may not feel that this is the case. So essentially, another potential channel comes through these informational asymmetries that exist. And such information asymmetries actually, as there is by now fairly extensive literature in this area, was considered a powerful transmission mechanism again for the financial crisis of 07, 08, 09. And also, the problem is that similar mechanism also affected other financial intermediaries like hedge funds that get a lot of their financing from banks and so on and so forth. So suddenly, the fact that some assets on the balance sheets were not considered as safe anymore suddenly start having a lot of cascading effects. And, the other types of work that has been considered recently in the literature is about endogenously emerging risks. And in this particular mechanism, again, it has something to do with how the information set is affected. Once a bank fails, a lot of the knowledge that that particular bank had about its portfolio and its customers is sort of lost, and therefore, if that leads to additional banking failures, so once that information starts getting lost, other people are not really willing to start trading on these assets. So that starts creating liquidity. If that starts becoming cascading, suddenly you start having an explosion of illiquid assets, which essentially worsens the problems, because then again it translates back to liquidity type of problems. So you see how there are a lot of transmission mechanisms, and all these sort of need to be taken into consideration. And the interesting thing is that all these finance econ type of papers also put networks as part of this exercise. So it's not only that they have the economic aspects and think about the channels, but also the role of the network. And so moving on, since I've mentioned networks, again, you see a number of the papers that I have already mentioned and some new ones that start thinking about the role of the network and even the topology of the network. So what type of linkages are we thinking about? And in some aspects, the linkages are kind of physical linkages because there is a contractual agreement, one bank lent to another. In other cases, is more the linkages are more come from sort of a type of statistical association, kind of a correlation, because if two banks sort of hold very similar types of assets, you start thinking that their behavior is going to be sort of correlated. And therefore, this is sort of the next theme that comes up in the talk. We're going to start thinking about examining physical networks where there is the link between two entities, in our case, two banks, has a perfectly physical meaning, like direct contractual agreements or common holdings, and also correlation networks where it's sort of through equity type of returns. And the last piece in terms of this literature review is what is the role of the topology and whether some topologies connecting to some topics that were discussed in yesterday's presentations make the system more resilient or actually more vulnerable. So there is an emerging literature, again, all of these are econ or finance papers, where they are thinking about, whether the degree of connectivity, if you have hub nodes or if you have a very strongly connected component or some other aspects of the topology of the networks are beneficial or can harm the stability of the financial system, and therefore what are the implications of the network topology on systemic risk. All right, so moving on, essentially what we would like to do is analyze both physical networks and correlation networks, because the physical network captures kind of the interbank lending, the direct contractual agreement type of mechanism, whereas this translates to common asset holdings more to behavior between banks from the equity return perspective. And with the data that we're going to examine come from Europe, because I'll explain when I come to those slides. And then eventually there are a couple of questions. How do we build physical networks? That's fairly easy. How we build correlation networks? That's where the stats part of the talk comes in. And then briefly we would like also to address this type of questions. What is the information content of the two types of networks and how their structure is correlated to exogenous shocks? And at a very high level, I'm gonna just say one word about potential implications for systemic risk and macroprudential financial supervision. All right, so one difficulty, and I'm going to go a little bit quickly, is yes, you have these physical networks, you have these correlation networks, so suddenly you see that there are two types of information, and there are two types of networks sitting on the same set of nodes. The only difference is that the type of edge is different, and it reflects completely different set of information, or potentially different set of information, and the question is there any type of linkage between the two in order to understand and interpret the results. So on this front, we essentially are going to use previous work that has also thought through the balance sheet of a bank. In the interest of time, you can quickly look at, essentially, the key things to remember is that the XIJs are loans from one bank to another, and the YIKs are other assets of banks. EI is the equity, and DI is liabilities to non-banks. So eventually, you need to have, it's accounting, you need to have assets, liabilities, and of course the identity assets equals liabilities. And eventually, if you rewrite this equation for all the banks, eventually you get this type of equation. The key thing to keep in mind is that on the left-hand side, essentially, is the interbank market starts emerging, because essentially it's all the contractual agreements between the banks, and because of the accounting identity, this is equal to the assets or the asset classes that the banks hold minus equity minus liabilities to other non-banking entities. And in this exercise, we are going to assume, again, following developments in the literature, that the D moves at a much slower time scales than, for example, the interbank market. The interbank market has a lot of volume on a daily basis. Some of the data that are going to come up in a second, for example, for the European interbank market, the number of transactions is of the order of 18 trillion euros, whereas D is essentially debt claims by households, mutual and pension funds. So this change over time, but at a much slower time scale. So this starts giving you a flavor of how the interbank market sort of starts behaving. And then if you start aggregating across all banks, eventually all the interbank transactions essentially cancel out. Essentially that's what this slide says. And you can sort of look at the network for equity returns and how sort of it relates. So the upshot of this very little, very fast accounting exercise is that there is a physical network that has to do with transaction data and therefore closely captures liquidity in the banking system. And then you can think about a correlation network, but needs to be inferred from market prices, essentially stock prices, and its behavior is driven by investors, whereas for the physical networks are driven by sort of the internal actions of the banks. So physical network has much more to do with liquidity, whereas correlation networks are driven sort of by a lot of other factors. So finally, how do we so for physical networks, it's easy sort of to construct them if you have access to the right data. Essentially, in our case, we purchase the data. You look at all the transactions and you can aggregate them at the hourly, daily, weekly, monthly scale. And essentially, that's sort of, the edge has kind of a physical interpretation. It tells the total transaction that between bank 1 and bank 2. And if you want to be even more sophisticated, you can have bidirectional links. How much one bank has lent to the other and vice versa for different periods of time and so forth. However, correlation networks essentially need to be inferred, so that's a statistical problem. So very, very quickly, let me tell you how people have done it in the literature. Essentially, you look at log returns, and it's by now customary sort of to filter them through a Garch models, sort of to normalize the data a little bit. And then after that, once you sort of have this normalized, so to speak, data, you can construct any correlation network that you like. You can use Pearson correlations, or given all the developments in high-dimensional statistics, partial correlation networks by using penalized approaches. Lini briefly introduced the SCAD, or by using lassos, or partial autocorrelation networks, which essentially correspond to vector autoregressive models. So let me give you a flavor of, because we're going to construct these types, and there are a number of recent developments of how you can construct partial autocorrelation networks. One way that a lot of people have done them is essentially using the old idea of Granger, regressing the returns of one bank on its previous lags and one other bank. But this doesn't sort of take all the information in the system, so a better way to do it is by building the partial autocorrelation network simultaneously, and this leads us to the other VAR model. Not the VAR at risk. For me, VAR is with capital V, capital A, and capital R, so it's the vector autoregressive model, and this is sort of the definition. So essentially, the log returns at time t depend on a number of previous lags from all the other banks in the system, and given the fact that here is the key point, if you have P banks, let's say 50 banks in your system, you're going to have to estimate 2,500 parameters times the number of lags. So you see, you start running out of data pretty quickly, and that's where modern approaches, that use penalized type of estimates come into our rescue. So eventually, as is well known in the econometrics literature, you can turn the VAR problem into a gigantic regression problem, and the only thing that you need to worry is that you have too many parameters in your regression and not enough data, so sparsity is one approach. Whether the real networks are that sparse, that's still a more empirical type of question, but if you believe that they are sparse, then you can either use classical lasso, or if you believe that there is some additional, dependence, contemporaneous dependence, because your error terms are correlated, then you need to go a little bit more sophisticated and use a maximum likelihood. So right now, there is, in the last 4 or 5 years, there is a rich literature that provides not only how we obtain the estimates, we know that under certain conditions they are consistent, and the error rates have kind of nice interpretations. Essentially, it's exactly what we know for high-dimensional regression, and you have to pay a certain price for temporal dependence. And as I pointed out, by now, there is a rich emerging literature of all variants of vector autoregressions and how you can estimate them and so forth. So let me tell you in the last, hopefully 5 minutes about the data and what are the implications from the physical network and from the correlation networks that we built using vector autoregressions. So this is the IMID data set. So IMID is, if I remember correctly, is a platform run by an Italian company in Milan that essentially keeps track of all interbank transactions in Europe, and right now it has also starts covering the American market as well. But back then, it was only covering Europe, and that's why essentially these are European data. And for the physical network, the data, and you have to purchase the data, you have to pay money. So there were 212 banks, essentially all the big European banks were in the system. On the other hand, many of them are not that big, and therefore they're not publicly traded. And so you see there is sort of kind of a discrepancy. So what we decided to do is build the physical network for 212 and then limit the analysis on the subnetwork that we extracted that matches those for which we can build a correlation network. And then we did a lot of analysis trying to understand, to identify breakpoints, and so in order sort of the data to be to a large extent stationary within the periods. And of course, all these periods make a lot of sense. It's the pre-crisis period, the first crisis period that goes from the first warnings in terms when liquidity started drying up in early August of 2007 until essentially Lehman collapsed. Then the second crisis period, intervention by the US Treasury, intervention by the European Central Bank, and then the third post-crisis period, when sort of a nascent recovery started taking place and so forth. And so one of the problems is once you construct these networks, either you estimate them or you build them from the transaction data, how do you summarize that information? You have a lot of information even for 54 banks, and somehow you need sort of to extract. That's where network theory comes potentially to the rescue. There might be even other approaches. And it's customary sort of to start looking at these summary statistics that capture, as the slide says, different aspects of the network topology. And here is what we see. So for the physical network, there was a very active connectivity. So there was a lot of liquidity around in the system, which started going down at around 2007, and eventually, to a large extent, I mean, these are different measures, but essentially the key thing to keep in mind is that liquidity started drying up, and eventually it was never restored, even 2012. Looking at the literature, some people have reported that actually liquidity in the interbank market, in the European interbank market, had not even come back even in 2016. So somebody will ask, okay, who has replaced liquidity? And that's the European Central Bank. So essentially, the lender of last resort has essentially supplanted the whole market. On the other hand, for the correlation network, we see something very, very different. Not too much activity, not very strong correlations, because these banks, remember, it's a European market, they belong to different countries, that their equity returns are also driven by a lot of other factors, not just the monetary policy and the monetary environment that is subject to, the policy of the European Central Bank. And then essentially we start seeing a lot of connectivity because essentially markets start plunging, so suddenly you start having these very, very strong correlations that they start dissipating way past 2012. So you see a very, very different behavior, and then the question is, okay, the network information tells us decrease in the physical network, so drying up of liquidity, a lot of correlations from the equity type of returns, but can we sort of connect these network connectivity measures that we extracted to economic shocks? So the basic premise is that markets tend to react to announcements. So at this point, we're trying sort of to come up with explanatory mechanisms or gaining insights of why these things happen to networks or to these types of banking networks. And therefore, the shocks of interest are either interventions, refinancing operations, and so forth, or announcements. And some of the announcements by the policymakers, as we know, can still move markets or move markets substantially. And of course, broad macroeconomic shocks. And again, it's challenging where you get the data. So a lot of the data were extracted from previous papers, so contacting the authors and getting their data. And the methodology is very, very simple, although it's fairly popular in the applied econometrics literature. Essentially, you run regressions with the network connectivity measure as the outcome variable, and the shock variables as the predictors. And you can read sort of the key summary of the findings. Essentially, the interconnectedness adjusted strongly to all the central bank operations. You know, there is a very, very tight connection, even on the transmission channel. And whereas interconnectedness in correlation networks did not change with respect to these events. It primarily responded to other macroeconomic factors and shocks. And the last thing is, okay, right now, thinking a little bit more about the policymakers, as you start constructing all these networks, can you use them to forecast a few days ahead some measures of economic activity? I mean, you know, you don't believe that there are going to be very, very strong correlations, but by having captured all this information in this network framework, can these additional regressions, where you have extracted the degree or the clustering coefficient, and you put them in a regression type of framework, can they help you with sort of prediction or forecasting? And essentially, our conclusions here is that we see very significant coefficients in terms of industrial production and retail sales from both networks. And also the physical interbank trading networks identify weakened interconnections in the interbank system that eventually start giving you some idea about liquidity problems in the future. So the point of the last two slides, trying to think of more explanatory mechanisms, is that the shocks or the patterns that you observe in the networks are a function, or they are related, or they are responding to either various types of announcements, even by policymakers or other macro conditions, and at the same time, they have some forecasting ability for real economic activity type of indices. And so essentially, when we start thinking about systemic risk, it's a very complex problem because of all the various aspects of risk. Here we just focused primarily on contagion risk, and there is an emerging, or by now a fairly mature literature on what the role of the networks that play and they connect to contagion risk. There are multiple channels, so when you start doing this modeling, it's not enough just to build the networks. You need sort of to understand what information they capture and how they are connected, because there are both exogenous and endogenous shocks. And okay, all this is nice and fine, but with the exception of the regulators, a lot of this data are not sort of available. If you're a central bank, you know, you have regulatory authority, so you can extract a lot of the data from the interbank markets, and by now there is the necessary infrastructure. The only easy networks to construct are these correlation networks, whether you use VAR models or simple correlations, doesn't matter, because these are sort of the only publicly data available, but these only capture one facet of this more complex landscape, and that sort of becomes a big challenge for future research. Thank you for your attention.
Thank you. Thank you very much, George. Do you have any questions for George from the audience?
Okay. One big reason of the aggressive behavior of the feedback before the final process is that if they fail, the central bank would self, right? So that's kind of we call in is implicit guarantee. So my question is, from the the network perspective, is there any way to calculate or characterize those kind of the free option we tested here gave to the too big to fail back?
Again, this points out to all sort of these difficulties because essentially the question is how these expectations are built in the transmission channels. At the end of the day, the network captures these channels, but you need sort of, if you really, you can tell stories, but if you really want a clean characterization, at some point, the economists in the room or the people with more finance background can correct me, but probably you need to build an economic model, impose general equilibrium conditions, incorporate expectations about market participants' behavior, and then sort of try to understand how this translates. So in many of these cases, even of how the links come about, you may have to build additional economic models in order sort of to make them even more interpretable. But expectations play a big role. Essentially, that's what you're hinting, and therefore, you can see them in a statistical measure, in a statistical association, whether it's correlation or partial correlation. But when you start doing these forecasting exercises or trying to intervene in the system and start having policy decisions, at that point, you need to keep in mind the Lucas critique, that you're intervening in the system, and therefore you need to have a model that you understand how you're intervening in the system, whether you change expectations and so forth.
So Ed and Gale actually have a model, a model.
Yes.
To incorporate the same back.
Yes.
So is there any way to incorporate it?
The problem is with a lot of these models, even the Allen Gale, the Asymmetry models and so forth, they are very nice theoretical constructs, but unless you are the regulator, none of us is going to ever have access to this data. That's the problem. Or unless you work very closely with the regulators. These are highly proprietary data. And even, the first author in the paper is the chair of the risk group at the Federal Reserve. And he told us that if we want to do that exercise back, let's say, in 2011, the Fed didn't have the infrastructure to monitor the interbank market. Right now, after the crisis, of course, they put that infrastructure together. So you see, data acquisition issues are very, very tricky here.
One more question. Yeah, Danny.
So my question is more on the topology of networks that you mentioned many times.
Mm-hmm.
So forget about this data. Perhaps there is publicly available data on which we build networks or whatever. So my question is, are you talking about building persistence landscapes and using that to characterize the structure?
No, here we kept things so very simple. Essentially, we look at all these type of network statistics. So you look at the total degree, or if there were important nodes at the degree of that node, we calculated closeness, clustering coefficients, or how, whether there were hub nodes. So these are very standard measures in the network literature, but once you have a network, once you have an adjacency matrix, you can calculate, and this became our summary statistics. But, at some point, in order to do any of these exercises, at some point you need to summarize the network. What's the best way of summarizing the network? That's a very interesting question. People have thought about it. These are customarily used, but it doesn't mean that this is the last word on it. But at some point, think that you have, a network with 2,000 nodes. It has a very complex topology, so you're trying sort of to summarize it. Depends on what you're trying to do with that summary measure. For small networks, pictures are nice. They give you a lot of insights, but otherwise you end up, even these are small networks, and you see the hairball phenomenon. So it's very difficult, apart saying, oh, it's connected, and this gets more connected, but it's really difficult then to do any more analytical work. That's another challenge with networks.
Any more questions? Okay, we have a lot of interesting talks for the morning, and you will have to digest your food, but you also digest all the ideas that you receive here. I want to thank George again and everyone else. Now, let's give a big hand.